This is Michael Fox, and this is the Prospector News Podcast. And I have joining me longtime friend, analyst, and author of the Silver Stock Investor, Peter Krauth. Welcome, Peter.
Hi, Michael. Thank you for having me again today. I'm looking forward to our talk.
I am as well. We tried to tee it up. We were together in Las Vegas at the Silver Symposium, but your schedule and my schedule over that busy weekend just never quite meshed up. But it's allowed us to look at current events a little bit more with the eye towards the silver market that, quite frankly, we couldn't have foreseen in Las Vegas as well. So timing sometimes works out for the better.
I agree. Exactly. There's been some interesting developments, and those are since we were together in Vegas. So that gives us some really good stuff to chew on.
Yeah. The interesting thing I found with Vegas and the event there was that, unlike a lot of events that happen in Vegas, the people that attended were actually there for the event. You know, they were there on the Friday night. They were still there on the Sunday at the end of it. And they attended a lot of the talks and were engaged with everybody. So unlike what everyone says, that it's poor market sentiment, we didn't really kind of see that in Vegas, did we?
No, you're right. And that actually quite surprised me. It was my first time at the Silver Symposium. And I would completely agree that the attendees were quite motivated to learn, to hear about the different things that people were talking about. We did talk a fair bit, of course, about silver and precious metals in general, but we talked about market conditions. We talked about a whole number of things, and the room was full almost the entire time. People were very intensely interested in what the speakers had to say, and it was really a bit of an eye opener. And like you say, I was myself actually a little bit taken aback by the level of, I guess, the level of sentiment really by these attendees. It's almost like the mining companies were were less had less conviction than the investors. So you have to ask yourself, because obviously the worse sentiment tends to be, the better contrarian indicator that it is. But that's not always the case. And of course, like we said earlier, there have been some unfortunate events in the Middle East that just developed, unpredictable, of course, to most. And so that changed the fortunes of precious metals very quickly. And that has certainly turned things upwards. And so maybe the sentiment, the overall sentiment, if you factor in how the mining companies were themselves sort of feeling about things at that event, was a pretty good indicator of what of where things were headed, at least in the near term.
Yeah, I wouldn't disagree. Not that anybody wants to see war or anything, but I think the outbreak of hostilities actually saved the precious metal markets in the short term, because gold was reaching a death cross on a downturn, and there was a cascade if it had crossed over and stayed there before the hostility broke out. And of course, as the world burns, gold turns. It took them that market up away from that death cross, and silver generally follows the direction of gold, so that wouldn't have been a good thing for the silver market either.
Exactly. In fact, gold went from, within about, I'd say, a week-ish, from about 1820 to about 1940. So $120 in about a week. That's at least 6%, which is tremendous in that. Is that six? Yeah, about 6% in that time frame. Silver gained about $1.75 an ounce, or over 8% in about that same time frame, from roughly $21 to $22.75. So you're right. Both of them bounced really hard, rallied really strongly. We've seen a little bit of a pullback since then. But as is typical, and people will often say, so what's going to happen since we've got these events? What's this going to do for the precious metals? And if the question is it sustainable? My answer is usually, well, it depends. And the one thing we do know for sure is that the war premium itself, the initial premium, tends to fade. We saw that. I think it's pretty unarguable within the first weeks and months after Russia and Ukraine war erupted. Gold popped above $2,000 temporarily, dropped back to 1,800-ish within months. Silver rallied to $25 and then retraced to about $21. So unless the conflict escalates, I expect some at least of this premium to at least dial back. And we may already be seeing the beginnings of that right now.
Yeah, the geopolitical spikes generally don't last very long, but as I say, it came at a fortuitous time. Given where the market was. Now, I describe this market as waiting for Godot. I think you heard me say that to several people in Las Vegas.
Yes.
And,
yes.
We're all familiar with the play. And, unlike the play, we know that Godot is actually going to show up into the market and the precious metals will see their day again. But there will be some people that'll be like in the play and throw up their hands and go, he's never coming, and they leave.
Exactly.
What is going to be the catalyst to get these markets to turn and have Godot actually show?
Right. Well, I mean, on that first point of, as you say, that unlike in the play, this will turn and Godot will show up. And I think that, and I've said this several times before, and I even talk about it in some detail in my book, The Great Silver Bull, how one of the biggest things that investors that understand precious metals, and really technically all investors should at very least understand them, but is that a lot of people and notable people like Ray Dalio, for example, of Bridgewater, has said that if you don't own gold, you don't know your history, and that too many investors suffer from recency bias. And if you think about what's gone on over the last 40 years nearly, is that essentially stocks and bonds, broader stocks and bonds, have been in essentially a 40-year bull market since roughly 1980, 1982. So that's a whole long time that's more than a generation, essentially, of people who've really lived nothing else. So to be telling someone that we're at the end of this, I think it's really hard to convince them. It's hard for them to let go of it. And so I think recency bias is probably one of the biggest enemies for investors that are having a hard time opening their mind to a switch. I gave a presentation, I'm going to say about a year or so ago, maybe even a little bit longer. And the whole premise was transitions are messy. And what I talked about was how if you looked at exactly these two bull markets that started the precious metals bull market essentially ended, the 70s bull market ended in around 1980. And the stock and bond bull markets more or less started around that same time. But if you look back at how these assets behaved, those transitions were messy. These were not things where you flipped a switch and something peaked and then it was straight down from there, or something bottomed and then it was straight up. In all three cases, it pretty much took, I'm going to say, roughly 2, maybe in some cases 3 years for a clear change in direction to manifest. And so that's where I think we are right now to some extent with the precious metals. And I think that people not being open to this possibility, and that this transition to a new longer term bull market in the precious metals, not being open to that, likeliness even is going to have people do themselves a really big disfavor. So if you'd like, I think you said that, Michael, that the second part of your question was going to be what will make this change? What will bring sort of this I guess more clear change in direction ultimately for the precious metals? Is that right?
That's correct. Yeah, there's, in order for the metals markets to change, there has to be a catalyst. Otherwise, we're going to continue on waiting for Godot to show up. So, what is that
Exactly.
catalyst going to be?
So, I mean, I would have to say that, it's clear that just looking at what's been running against the precious metals recently, until at least very recently, has been weakening bonds, which means higher yields in bonds, which makes especially short-term bonds attractive. If you can get a treasury, a US treasury that's paying you 5%, why would you be interested in stocks? Why would you be interested in precious metals? The US dollar has been running up pretty dramatically for the last several months. The dollar index recently hit a high of 107. And so that makes the dollar quite attractive in terms of currencies, period. And it's obviously the world's reserve currency. So these are two really big safe havens, probably the two biggest markets, period. US cash and US treasuries. So that certainly is a headwind for precious metals. But I do think that the dollar may have, at least, I'm not saying that ultimately the dollar cannot run higher. I'm quite open to this dollar milkshake theory by Brent Johnson of Santiago Capital, saying how ultimately, since we have such strong rates in the US, that sort of sucks the liquidity out of the markets. It helps to feed the strength in the dollar, and it will likely eventually lead to some kind of a sovereign debt crisis. And the nutshell explanation of that is so many emerging market nations and emerging or foreign companies issue debt in US dollars. So when the US dollar runs up, it gets exceedingly difficult for them to buy dollars to be able to make their debt payments. And so ultimately, this will cause serious, very, very serious pain, likely some kind of a sovereign debt crisis. So that being said, I think that the dollar could and would eventually have another strong rally. That could be a few years away. In the sort of nearer term, I think it has peaked. I think we're going to see some weakness. I think we're going to see a bit of a reversal even in the treasuries, which have run up dramatically. There's been a lot of weakness in treasuries recently, which has helped their yields run up. I think that's going to bounce back a little bit. We'll have a counter trend rally where people will start to buy some of these longer term treasuries, and that will help push down their yields a little bit. And I think really what is going to trigger the ultimate bottom in the precious metals is when central banks ultimately stop raising rates. They're going to have to do it at some point. I don't know how close we are. Some people are talking about one more hike. Some people are talking about two more hikes. It feels as though 1 to 2 is possibly the limit. I say that because I think that that's going to break something in the markets. And I think that the action we saw this late winter in March or so, when 4 US banks went under, and then UBS in Switzerland acquired Credit Suisse with its own scenario. I don't think that is over. The banks are suffering. They have a lot of treasuries on their own balance sheets. They're suffering because those treasuries are losing value as they're being sold off as rates go up. And the banks do not have the ability to compete with treasuries, short-term treasuries. They can't pay the kinds of yields that treasuries are paying right now at 5%. So they're not attracting money. I read something recently. I think it's the first time in something like 20 or 30 years that in a quarter, U.S. Bank deposits have actually gone down. So this is like, uncharted waters. And I don't think that the banking crisis is over. I think that could easily come back to haunt the markets. And if we do see that sort of thing, or some black swan that no one can foretell right now, that will cause the ultimate end in rate hikes. I think that the Fed will finally back off completely. And when the market, precious metals are great for this sort of thing. They tend to sniff that out sometimes as much as several months in advance. So if we start to see some reasonable strength, ongoing, consistent strength in the precious metals, I would actually start to be concerned and have my antenna up for some kind of capital market, bond market, currency market problem to manifest itself. And I think that will be the firing shot when we'll start to see precious metals finally have a sustained multi-year rally that will start this sort of last leg of what I feel is a secular bull market.
Yeah, I wouldn't disagree. I'm thinking that in the short term, we may start to see a bit of a short-term little blip upwards here in the precious metals. My thought on it is that the Fed is likely to maybe pause at least one more time, and the markets may misread that as being the pause. And
Right.
so that may cause them to run in a short term, but long term, I'm thinking exactly the way you are, that there's at least another probably 2/4 point hikes coming, and that that being the case, it'd be really interesting to see what happens then, because they could very well break something.
Exactly. And I think, yeah, I was
But
just
I
going
think
to,
for the regional banks, though, they're kind of risk off with the treasuries, because the Fed has already signaled that they'll bail them out with buying back those treasuries at face. So
that's true. That is true. Absolutely. If we go back for a moment to the talk about potential additional hikes, I think, and you tell me if what you think, but given where inflation is, and the latest reading now for September was at 3.7, that was the same as it was in August, despite all these rate hikes that we've had. It was up. So that was, over the prior 12 months, we had a 0.4% increase for the month itself of September. This is still at 3.7%. That's still nearly double the Fed's official target of 2%. They're going to have a hard time backing off and not having at least an additional hike, given these kinds of headwinds. And again, employment holding up relatively strongly. And this is the CPI. These are readings that don't include shelter, energy, that sort of thing. So if you include that, I mean, the true cost of living is considerably higher. The Fed knows that, and the Fed's own preferred measure of the CPE, sorry, the PCE, personal consumption expenditure, that index is actually higher than the CPI, closer to 4%, and so or a little bit above. So it'll be very difficult for them to justify not at least hiking one more time, and that may be the straw that it takes to break the camel's back. Time will tell. It may take one more than that. These things need to sort of play themselves out. Anything can happen in the meantime, but it wouldn't surprise me as if that is a significant and sufficient contributor to a change of direction for precious metals.
yeah, Chris Temple and myself, we did a podcast last week. Go to my YouTube channel if you want to hear that. But we were discussing what the Fed is in fact going to likely do in this next rate hike in the early part of November, and Chris is of the opinion that they're going to hold the fort for now, because we've had war breakout, the bond markets have risen. They thinks that the bond market may have done some of their heavy lifting for them. I was a little less optimistic. I thought there was another quarter and another quarter in December. But Chris and I'm asking, that's the lead up to asking this question. We're of the opinion that because the next opportunity after November 1st for a rate hike will be in the early part of December. And by that point in time, the early Christmas sales from the US Thanksgiving holiday weekend will be in. And he and I were both of the opinion that those figures could be the key to whether or not the Fed continues to raise rates or not going into the December meeting.
Yeah, I mean that makes really good sense. I was actually listening to something this morning, a news report that said that people are dialing back in their spending. There are certain places where they're not hesitating too much to spend. One of them is travel, and the other is entertainment to some extent, and they're still very much willing to spend with the environment and with sustainable, I guess, scenarios in mind. And so there are ways and places that people really are still willing to spend and actually pay premia in different ways. So it will be interesting to see how those statistics play out, as you say, at the end of November, early December. And yeah, that makes sense that they would base their final decision for December on that. And I agree with you. I think that for now, at least, unless things heat up too much or more so in the Middle East, I think that the November meeting is likely to lead to a hike this time around. So we will have to see how that plays out, what it does, and go meeting by meeting. But I think that right now, from what I see, the data that I see, I do think that a hike is likely in November.
Yeah, that was my conclusion. And the other part of that was that I felt the Fed would be reluctant to continue to raise rates during an election year, although it's supposed to be an apolitical organization. But if they need to get a couple more rate hikes in, they probably wanted to do it before this year was over.
That's a good point as well. Yeah, that's true. And it may be also a bit of a, it would not surprise me to see inflation stay robust the way it has been. And so that in itself, well, of course, combined with, like you said, these Thanksgiving sales results, that's part of the same parcel and package that that spending stays high. And that may actually help to feed inflation. And I could see them wanting to deal with it sooner than later, getting all of that behind them. And inflation has stayed stubbornly high. So December is a ways off, but not all that far. And if the same kinds of numbers hold up, then I would say that a hike in December is certainly not off the table.
Yeah, well, I think you're right, though. We are starting to see Godot show up on the horizon because it's become less easy to predict what the Fed is actually going to do. As we've moved further and further along in this year, it's become, well, they may not. And there's justification on either side of the equation as to whether they should or shouldn't hike. And if the catalyst is, as you say, the Fed pauses and signals that they're done hiking in the short term, that could be where the catalyst is. And Godot opens the door and says, pour up,
Here I am.
here.
Exactly.
So what is your thoughts for 2024? Are we going to start to see that market uptick? We start to head into the seasonality. Is seasonality going to hold in 2024, or are we going to see a situation where the precious metals could just continue on for a long run and seasonality be damned?
Well, I think that it may actually be a bit of a mix of the two. I don't think the effect of seasonality will go away and not have any impact. I do think that it's possible, depending on how things play out with Fed rate hikes, if for whatever reason they manage to get, I guess, what they're aiming for, which is their soft landing, and that brings us to, say, mid 2024, for example, then we could have precious metals, I think, sort of start to climb, at least if we don't get some sort of a really explosive rally or anything like that. We could still see them start to climb gradually. And so I'm of the opinion that the first half of next year, and especially the first quarter, could still be relatively strong for the precious metals. We could see gains start. I think that given the struggles that they've had for these extended periods, sentiment can only stay down for so long, and ultimately, I think that these low prices will be a cure for the low prices, and we've seen considerable strength in gold and in silver when they got sold off, even just recently. And it's true that this time around there was this Middle East conflict that helped put in at least what for now we can only call a short-term bottom. But I have the sense that the metals would have, at the very least, trudged along those recent bottoms and not necessarily have fallen any farther. We're getting close to, quite close to all-in sustaining production costs for the metals. And so that often, it doesn't mean they can't go below, and they do, but that usually doesn't last very long. And so that helps me, I guess, helps bolster my case for being quite hopeful for the first quarter of next year, once we get tax loss selling behind us, and then we start to move into the effects of the holiday season, and then Valentine's, and then Chinese New Year. There's all sorts of buying that comes in as well in the early part of the year. So I think that these will certainly help the precious metals along.
Yeah, I'd like to see Godot show up as the New Year's baby, and the old bad markets leave us by the end of the year. But yeah, I would agree. I think we're in for a little bit more hesitation through the last quarter of this year before we start to see signs next year.
Right.
So exactly. People want to follow you, Peter. How do they do so? How do they get on your mailing list? Or more importantly, how do they buy a copy of your wonderful book?
Yeah, so my book is available on Amazon. It's The Great Silver Bull. That will be easy to find. It's in paperback, in audio, and in Kindle. You can follow my work by going to silverstockinvestor.com. That's where I publish the only silver-focused investment newsletter. And I'm on Twitter and on LinkedIn. Twitter at Peter_Krauth, LinkedIn Peter Krauth. On YouTube as well, resourcemaven.ca. And that's probably the easiest way to follow what I research, what I do, what I talk about, and all of the travails of the silver world.
Wonderful. It was good to see you in Las Vegas, and I hope our paths cross again in the same city soon. And but we'll stay in touch as we watch the markets play out through the year.
Yeah, I thanks for that. I enjoyed it as well, and I'm sure our paths will cross again soon.
Thank you, Peter.
My pleasure. Thank you, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.